SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Ladies and gentlemen, we're now diving deeper into cross-Atlantic views of the new policy mix post-GFC and post-COVID. Policymakers face a number of formidable challenges and aims with various time horizons right now, ensuring a sustained recovery from COVID, with inflation reaching targets, aging, Joseph Stiglitz just mentioned also inequality and climate change. Already the post-GFC economic challenges, but more so even the COVID crisis, have moved the question of the optimal policy mix between monetary, fiscal, structural, and financial policies, which has long been in hibernation until at least the GFC, have put it back center stage. The COVID crisis was successfully countered through ultra-expansionary monetary and fiscal policies, as Joseph Stiglitz just described, combined with sectoral support and supporting expansionary macroprudential and regulatory policies. The challenges we are facing now are, first, how fast to exit these policies, not too early but not too late, as François Villeroy de Gouaillot put it, to avoid both cliff effects and setbacks with respect to the recovery and the achievement of price stability, while not provoking overheating with ensuing financial stability and inflation risks. Secondly, we also need to get right in which sequence measures are reduced or faded out. The latter raises both issues within countries, within individual policy areas, but also internationally across countries, notably the US and Europe, but also, of course, other major economic blocs. Lately, also the question has arisen what to do if the recovery were to stall. It was mentioned already earlier in this conference. Would monetary and fiscal policies have sufficient ammunition left to reinvigorate the recovery? And what if we faced a financial crisis? We just, over the couple of past weeks, noticed with interest Evergrande developments in China. And despite the reformations by Governor Villeroy de Gouaillot, what if, according to some observers, what if stagflation akin to the 1980s were to come back? Now, we have excellent speakers to address these issues from various angles. Elga Bartsch, Head of Economic and Markets Research, BlackRock Investment Institute, will provide a European view. Patricia C, Director of MPA Program in Economic Policy Management at Columbia University's School of International and Public Affairs, will then provide a US view. Debora Revoltella, Chief Economist at the EIB, will combine micro and macro perspectives. And finally, Jan Svejnar, Director of the Center on Global Economic Governance at Columbia University, will cover global trade aspects, including supply shortages and so on. We start out with Elga. The floor is yours, Elga.
Thank you very much, Ernest, and I'm just trying to share my presentation. In terms of looking at the macroeconomic policy mix, which is the focus sort of on my presentation, I will focus primarily on Europe, as Ernst said, but I will also map it against the US to also tease out some of the similarities on both sides of the Atlantic, because I think what Professor Stiglitz just talked about, how much we have moved on in the last few years from the Tinbergen principle of one instrument, one goal, and really got back to thinking much more actively about the policy mix and the interaction between especially monetary and fiscal policy. And I do think that in the future we will have to include climate change in this. I think that's sort of a global phenomenon, so I'll broaden the perspective a little bit beyond the continent here. But there are essentially two key shifts in the macroeconomic policy mix that are common. The first one is, I think, that we're in the midst of a macroeconomic policy revolution that basically not only puts a lot more emphasis on fiscal policy, but also is aiming to coordinate much more closely, much more deliberately between the measures. This revolution has been accelerated materially by the pandemic, during which we have seen unprecedented fiscal support to bridge across the disruption created by the pandemic. But we also are seeing a blurring of the boundaries, and that is something that will be crucial, I think, in the future, because the pandemic has left all developed market economies with much higher public debt levels, and that could potentially make the current low interest rate environment that we already discussed with Philip Lane more fragile, especially if you look at the possibility of a shift towards a higher inflation regime over the medium term. Because there is, I think there is more coordination and more awareness about the interdependence, but it's still not really actively managed. And it was interesting to see that the ECB strategy review was very silent for good reasons, but nonetheless, you know, I think on this issue, and this is potentially one of the most important issues that we are facing, because at the end of the day, for monetary policy needs an adequate fiscal backstop in the same way that fiscal policy needs an adequate monetary policy backstop. For both of these instruments retaining their ability to stabilize private sector expectations, which as Joseph Stiglitz just explained, can be unstable in extreme situations. So that's the first, the first common trend. The second, of course, is that central banks have adopted new policy frameworks with a view to carve out more policy space and to overcome the extended period of low inflation that sort of settled below target. And that has caused the Federal Reserve to move to flexible average inflation targeting, the ECB towards an explicitly symmetric inflation target, and a explicitly stated tolerance for inflation overshoots over and above what would be implied by a symmetric inflation target already. And that, together with a number of secular factors that will drive production costs higher globally, is likely to create a shift towards a higher inflation regime over the medium term. One of these cost factors has to do with more resilient supply chains, with more bargaining power for workers, but also with the need to fight climate change. And so what we are expecting is that inflation will settle at a stable level that sits somewhat above central bank targets, but not sort of gets into motion of a price wage spiral. And this, what I think is crucial about this is that through the new frameworks, central banks are becoming, at least at the current juncture, more deliberately more inflation tolerant, and we see this already affecting government bond markets in the sense that government bond yields react less to rising inflation expectations than in the past, pushing real interest rates deeper into negative territory. And that basically means that risks assets are supported, and that that is a new environment we sort of call the new nominal. The main risk to this new nominal world is that inflation expectations could get unanchored, paving the way to an accelerating price wage spiral rather than a stable but somewhat higher inflation regime than what we have in the past. And this, I think, brings me to something that central banks on both sides of the Atlantic are likely to face, which is more difficult trade-offs than what we have seen in the past, because in future we might see a world that is more likely to be dominated by supply shocks, not in the least because of climate change as well as the green transition, rather than by demand shocks, which is maybe something that really dominated the macroeconomic evolution over the last 3 decades. So what we are currently observing globally in terms of bottlenecks, and both François Villeroy and Philip Lane have talked about this, are the bottlenecks which are likely to be temporary, whether it's in the energy sector, the transport sector, the manufacturing sector, or indeed contact-intense services. And most of these are really caused by the extremely powerful activity restart that we have seen on both sides of the Atlantic, and that at the moment is somewhat stronger in Europe as the restart is broadening out. And it is true that it is possible and how should I say, probable that Europe will also prove more resilient given the higher vaccination and the lower degree of politicization as far as mask mandates are concerned. So what we are observing at the moment in terms of bottlenecks is most likely temporary and a function of this very powerful but uneven restart. The disruptions of the pandemic as well as the very generous fiscal support have caused a considerable demand overhang, and that's starting to reflect also in rising market inflation expectations. And what you can see is that inflation expectations in Europe have actually risen more than in the US, more steeply since the beginning of the year. In fact, you would expect something like that to happen, but when we look at the levels of these market-based inflation expectations, it is still, the market is still in doubt whether the ECB is going to be able to deliver on its 2% inflation target on average, whereas in the US, markets are broadly thinking that the Federal Reserve will be able to deliver that. Now, when we look at central banks' own projections for inflation, you can see that a similar message emerges. The Federal Reserve expects inflation to be above or at target, whereas in Europe, even with the likely upward revision in the December staff projections, in the out years of that projection, we most likely will see inflation falling back below 2% in a material way, and that's an important difference. So even with the new framework, the ECB is not yet in a position to deliver price stability, and that this close to the effective lower bound is problematic, and as a result of that we see the Federal Reserve getting ready to taper and to lift off in early 2023, whereas for the ECB, a first rate hike is still several years out, and additional QE is necessary. So in our own forecasts, we do not see the ECB raising rates within the next 5 years. For the Federal Reserve, we would see some modest rate increases, but much more modest than in past interest rate cycles, and more modest than what the market is pricing in. And that has to do with the fact that the Federal Reserve has not just changed its inflation target, but also the full employment part of its mandate, not just looking at employment in an asymmetric way, only considering shortfalls from full employment a problem, but also broadening the definition of full employment in a very material way. So that's a part in the US that goes well beyond what the ECB is doing, obviously due to the fact that the Fed has a dual mandate, whereas the ECB has a primary target of price stability. Now, just looking at some of the aspects, the dynamics on why things are different on both sides of the Atlantic. If you look here in the chart on the right-hand side, shows you the inflation dynamics in Europe. On the left-hand side, you see the US. And I think when we look at those inflation dynamics, you see, apart from the shelter component, which we do not have in a similar extent in the euro area, or not yet, the main difference really is that is domestically driven, is the services component. And I think that speaks to a number of things that were organized in a different way in the US than in the euro area. In the euro area, also in business surveys, we do not hear from services companies that they find it hard to find staff. That, I think, is in part a reflection of the fact that we used furlough rather than layoffs. But it also could be a reflection of how generous some of the fiscal support other than direct income support was. And I'll come back to that, because I do think that is an important point in this. So generally, the domestic inflation pressures in Europe are considerably lower than they are in the US. What is higher at the moment are the ones coming from energy prices because of what's going on in natural gas in Europe, which is a much more intense increase in prices than what we see in the US. Another key aspect that is different, and indeed very different, is the pass-through from producer prices into consumer prices. You can see that not only is the increase in producer prices much steeper in Europe at the current juncture, again, partially reflecting what's going on with energy, but the pass-through into the HICP is minimal, whereas in the US you have a much closer relationship. This could speak to the fact that there will be more margin compression in Europe, profit margin compression, than in the US, and again would mean that the current one-off temporary price shock that we have from various bottlenecks will have very different longer-term inflationary impacts than in the US. In the US, there is a higher risk, I would say, of things getting into motion in terms of second-round effects. In Europe, it could just be a one-off increase, and then, in fact, you sort of burn through a lot of the pent-up demand and go back to where we were in terms of lowflation. And one of the key, the aspects that I think is key is actually what happened with household disposable income in the course of the pandemic. On both sides of the Atlantic, we saw very sizable fiscal policy support, but in the US it had such a magnitude that it really pushed disposable income dynamics well above the pre-COVID trend, whereas in Europe it basically stabilized them and not sort of pushed them above the trend that was sort of visible before the pandemic. And I think this speaks to what actually happens with pent-up demand. Most of the pent-up demand in Europe is down to the fact that we weren't able to spend during the pandemic. In the US, there are also considerable excess savings from several rounds of stimulus checks that were pushed out, and that might also speak to what's happening in the labor market in terms of labor supply, because if you look at the employment dynamics in Europe and in the US, you see again a very important difference. In Europe, we are much closer to the pre-pandemic employment level. We could also potentially cross that high watermark earlier than the US, at least based on sort of the latest OECD forecast. That would be the case. And I think that's quite important because of the emphasis that the Federal Reserve puts on full employment, and the objective doesn't say minimal unemployment, but it says maximum employment. And because it's defined in a more inclusive way, as Professor Stieglitz just outlined, that means actually you also want to get the participation rate up. That is still a long way to go, contrary to the activity in the US, which obviously is already back above the pre-pandemic level. A key aspect of the whole story, and of course the policy mix, and that's I think where the US and Europe differ very materially, is the contribution of fiscal policy, which in the US has also a good part of that obviously has to do with the electoral cycle. Even though we had very unprecedented support on both sides of the Atlantic in the US, it was roughly twice the size as in Europe, and it was well more than the hole that the pandemic blew into the US economy. And that is a key difference. And so, and I think that is a reminder of the fact that the ECB in particular, more than the Federal Reserve, struggled to get inflation back to its price stability norm was due to the inadequate support from fiscal policy, the premature return to austerity after the global financial crisis. And that is, I think, why in Europe the upcoming discussions about the reforming or at least reinterpreting the rules of the Stability and Growth Pact are so important, because we cannot risk to derail this recovery due to austerity throttling it. So to sum up, there has been a policy revolution on both sides of the Atlantic. In Europe, there is an additional aspect, and we discussed this with Klaus Röckling earlier, about the creation of a common borrowing program, a safe asset in the euro area. We have revamped policy frameworks on both sides of the Atlantic. The Federal Reserve probably went one step further within its dual mandate. But one of the key aspects now to come in Europe is really to review the fiscal policy side, and that that conversation is just starting. And the only worst thing that compared to the Stability and Growth Pact and some of the tussle around it is, I think, the tussle that we see about the debt ceiling in the US. Thank you.
Thank you, Elga, for this very comprehensive overview. And I'm now interested to hear what Patricia, who are welcome with this, is going to answer to these various allegations. Let's put it like this.
So thank you, Ernst, and good morning, good afternoon, everybody. Thank you again for inviting me to be part of this conference. I agree to quite a large amount with what Elga's. I agree with quite a large amount of Elga's characterization of both the changes in attitude about monetary and fiscal policy in the U.S. and Europe and many other advanced economies as well. If you like, I think of it as the revitalization of fiscal policy as a countercyclical tool, which for some reason that kind of always surprised me. For the last 15, 20 years, it's been considered, not very powerful. Well, personally, I think it's always been powerful, but and if you remember, central bankers spent a pretty significant amount of time for the last dozen years or so complaining about being the only game in town before COVID. And the fact that we may be finally getting past that is net a plus, I think, for economic stability. So let me start by stating the obvious, which is for the last 6 months, the global economy and the U.S. in particular has finally experienced the aggregate supply shock of COVID. It was always there, but the demand decline was so enormous and so comprehensive that it was sort of hard to see. But we can certainly see it now. Because the U.S. and with a very small lag, the euro area was amongst the first in the world to recover, partly because they were faster with vaccines than most of the rest of the world. They have created a huge amount of pent-up demand. Worse in the United States. I agree completely with that analogy. And it created selective jumps in prices. U.S. core, both PCE and CPI inflation in this chart, the 2% target. I've also included a third measure here, which is a measure of the trimmed mean of PCE inflation. That's the green line. And the reason I include it is that it is it literally trims the outliers every month from the index. So not just food and energy, but all of them. And what I think is particularly interesting about the last couple of years of this series is that not only is the trimmed mean inflation in the U.S. significantly lower right now than the other measures of core inflation, but the deflation during COVID is not there either. So it really does smooth out, shall we say, the extreme values better than the others. Now, the time will tell if the trimmed mean inflation rate in the U.S. continues to be this stable. But if you're on the FOMC and one was inclined to be an optimist, you might start here. But let me take a half a step back because I do want to talk about policy questions and first monetary policy and then fiscal questions. And here I'm going to focus much more on the U.S. Monetary policy. To state the obvious, supply shocks are really, really tricky for central banks to handle. Now, standard operating procedure for central banks, including the Fed, is if you believe that price increases are temporary or transitory, I believe is the term of art that everyone's using these days, then short-term accommodation, meaning keep monetary policy loose, let prices rise, prevent growth from slipping too much, is completely the right call. And that's basically the view at this point that a very large number of central banks in the advanced economies have taken. To be specific, here's the US, the Eurozone, the UK, and Japan. I want to note what an outlier Japan is here. But the result of accommodation in the other three economies and a bunch of other ones that aren't in this chart has pushed short-term policy rates deeply negative. Deeply negative. And it's eased financial conditions in the very short run. Now, as long as the central bankers are right, this is a plus because not only is it going to help aggregate demand, but it's going to ease with some of the serious supply adjustments that we know have to be made. Some of them are temporary and will resolve themselves, things like transportation and so forth in the short run. It's not so clear to me that the some other supply constraints will be quite as transitory. I'll come back to that point in just a minute. By the way, these really negative short-term policy rates also make it a lot cheaper to finance those great big huge fiscal deficits and levels of debt that the advanced economies have, and the U.S. in particular has created over the last couple of years. Now the question here is how transitory, and I think there's using a word like that, particularly with when you're speaking to a group of financial market participants, is a little bit dangerous because transitory in finance is weeks and months. Transitory in inflation land is quarters, quite a few quarters, right? I have to say that having spoken to a number of people about this over the last few weeks, I am somewhat concerned that the idea in the United States is in inflation, and I sincerely believe this, the Fed is pretty serious about letting inflation run hot, not ridiculously hot, not 4% for years, but relatively above target, and perhaps for quite a lot of time, quite some time. That said, of course, the risk here is really obvious. The longer that higher inflation goes on in the U.S., the risk that price-setting behaviors and inflation expectations adapt, then the Fed's going to have a serious problem on its hands. So let me turn to the Fed directly and stay a few fairly obvious things. The first is, well, I have 3 points to make. One, it's very clear from the latest FOMC meeting, as well as the okay but not great employment report last Friday, that the Fed's going to begin to taper in November. They should be, if I've done my arithmetic correctly, it means they should be done sometime in July or August if they stick to a pattern that's relatively similar to what they used in 2013, 2014. Second, when the Fed is going to raise rates is much more uncertain. The new inflation targeting regime, the FATE, that Elga mentioned, creates a pretty significant amount of uncertainty. It has not been tested yet. This is new. There are excellent reasons why FATE was put in place, but I think it creates a certain amount of medium-term uncertainty, and not just in financial markets and not just in businesses, but I think within the FOMC itself. Based on the FOMC statements, and particularly as emphasized by the chair, the bar for raising rates at present is basically a full recovery across multiple indicators with a significant emphasis on diversity. Fortunately, that's a good news, certainly compared to the past. But that assumption rests on another assumption, which is that inflation spike is temporary, and that inflation doesn't run too far above 2% for too long. The uncertainty about this seems pretty clear if you look at within the FOMC, if you look at the FOMC's latest survey of economic projections with respect to when they're going to raise the policy rate. In short, the median is to start at the end of 2022, slowly raise rates over 23, 24. But let me be clear, there's absolutely no consensus about the speed here. All you have to do is look at the individual responses. The ranges for 2023 about how quickly the Federal Reserve is going to raise rates range from a year-end 2023 of going up nothing, basically being at 50 basis points, to 2%. For 2024, the estimates range from 75 basis points to 250 basis points, very evenly distributed across the participants in the FOMC. Now, I don't know how much of that is disagreement amongst the members versus uncertainty, but I would not be the least bit surprised if the vast majority of it is uncertainty. My third point, how hot is the FOMC going to let inflation run, and for how long? Let me pause for a minute and take fate very seriously, too seriously. It's worth remembering that the US has not hit its inflation target for 12 years. And on average, every one of those 12 years, they missed by 40 basis points per year. Now, if you do the multiplication, that means they've got 5 percentage points of annualized inflation that they could make up. And I use the word make up carefully here. Now, let me pause again and say what I just said is arithmetic. It's not economics. And that is not a prediction. I don't think that's what the Fed is necessarily going to do. But there's a lot of room here for flexibility in short run. What is clear is the Fed is willing on consensus to let inflation run hot throughout the forecast interval, basically through 2024 in their surveys. It's basically they average 2.2 inflation, so that's above target for at least 4 years. It certainly doesn't make up the last 12, but it's absolutely running above. It also suggests to me that they are concerned about the unevenness of the recovery, and in particular, the unevenness of the recovery in labor markets. If you like, it's a very dovish forecast, given where their real growth is. And it makes me think that the reason for this is the fact that they are worried about labor markets. And bluntly, they should be. You don't flip a switch and rearrange huge numbers of industries. One way to think about COVID is that it basically collapsed 5 to 7 years of what would have been structural changes in the economy and the labor markets. And it did it in 18 months. That's very tough. That's a lot, even in a flexible labor market like the United States, relatively speaking. Those are a lot of jobs and a lot of people that basically need to be shifted around in your economy, within the service sector and between services and goods. from less technologically intensive industries to more technologically intensive industries. I think it's possible that this could be a pretty sticky process in the labor market and could take a while. And I think the FOMC's forecasts reflect that. Let me finish with a couple of comments about oh, by the way, I forgot to say something about inflation expectations. I apologize for that. But as Elga pointed out very eloquently, inflation expectations in the U.S. Have basically returned to where they were in the mid-2000s based on break-evens. I'm talking about long-term. These are 10-year break-evens in inflation expectations. Again, there's for the moment, financial markets seem to be believing what the Fed is saying. Let me turn finally to fiscal policy before I close. This is a picture. Let me explain what this picture is. This is the U.S. total federal budget deficit, both its operating deficit and its total deficit. So the difference, the yellow bars being net interest. And it's a very long time series. As you will see, it runs from the 70s, and it includes projections from the Congressional Budget Office for out for 25 years plus. And this is as a percent of GDP. I want to emphasize that the estimates in this chart do not include any proposed legislation. These are simply current law and current experience. So this chart does not include, for example, the proposed infrastructure bills, both hard infrastructure and soft infrastructure, more social programs that amount to something like $4.5 to $5 trillion. Those are not in here. First of all, those things have been tabled in the United States for the moment for political reasons. Second statement to make is even if they were in their totality put in place, those are 10-year programs, which means they would average about $500 billion per year or 2.5% of US GDP. So even if you add those programs back in, starting in 2022 and 2023, it's worth pointing out that the fiscal tightening that's going to happen has already started to happen, actually. But the fiscal tightening that's going to happen in the United States over the course of the next year is absolutely dramatic. The U.S. did wartime finance fiscal policy, 15% of GDP in 2020, 13.5% of GDP in 2021. One of the reasons that the personal income growth is so strong is a 2021 factor. No matter how big those infrastructure bills are, they're not going to. They are not going to replace that. And so the fiscal policy contraction here is just, I think, is being somewhat underappreciated, perhaps sometimes. By the way, that in the picture here, the cut in federal spending is $1.3 trillion from 2021 to 2022, and the increase in revenues or higher and taxes is about $500 billion. That's how the numbers add up. One of the points I want to what I wanted to say, I want to back this up and say from a monetary policy standpoint, I think being cautious about how fast the recovery is going to be from here on is completely warranted. A couple of risks. The near-term risk with respect to the taper for the Fed is that COVID resurges as everybody in the Northern Hemisphere goes back indoors this winter, and the U.S. vaccination rates are stagnating. If that happens, and if the labor market slows down enough, because at this point the taper is all about conditions in the labor market from the FOMC standpoint, I think there's a risk that they could actually have to pause the taper. I viewed that as a minimal risk in 2013, 2014, but if there's very bad economic outcomes in the U.S., it's possible that it could happen this winter. Second risk, of course, is that inflation is way above target, and not only that, it starts now, so it starts relatively quickly. But a significant acceleration in inflation. In other words, everybody has it wrong. The central bankers have it wrong. The markets have it wrong. Everybody would definitely be a problem. inflation expectations go up. At that point, I have no doubt what central banks and particularly the Fed would do. They would be forced to basically accelerate the rate that they increase interest rates and their interest rate path. The problem is, of course, that's a really bad scenario, not just for the United States, but for the rest of the world as well. Inflation not being transitory is a problem central banks know how to handle, but it's not going to be a pretty picture if it happens. I think Andrew Bailey of the Bank of England had the best phrase about this a few weeks ago in his speech. He called it the hard yards. And for central bankers, that's the hard yards. The third I want to reiterate is my comment about medium-term risks. If COVID's aggregate supply shocks, particularly the labor market portion of them, are persistent and with us for quite some time, there's going to be a huge realignment in industries, the labor force, digitalization, not to mention climate. I haven't even touched on climate, but I agree with the earlier comments that others have said about it. We have not seen long-term supply structural problems in 40 years in the advanced economies. And you combine that with relatively new inflation regimes, central banking regimes, and I think it just creates an inordinate amount of uncertainty about the economic outlook and about inflation and about the policy stance over the course of the next couple of years. Thank you all, and I'll stop now.
Thank you very much, Patricia. You also touched upon a few structural aspects in the last few sentences of your intervention. And this leads us very well over to Debora, who's going to get a little bit more into the micro side. What were the effects of the crisis on firms? How are firms taking the crisis on as an opportunity for transformation? What worked differently between the US and Europe? Debora, the floor is yours.
Thank you very much, and while I regret not being in New York today, I'm happy that we still can engage in such a fact-based discussion, even if virtually. But we are talking about cross-Atlantic views and the new policy mix, and the angle that I would like to take in this panel is mostly on the European side and more at the micro-structural level, comparing the effect of the policy support on firms in the EU and the US, and discussing what are the challenges ahead that I see. And in a nutshell, I think the key message that I wanted to pass is that from the EU side, what we see is that the firm's resilience to the crisis, thanks to the policy support, has been much better than what we were fearing at the beginning. And we are ending the crisis with limited scaring effect at the moment, which don't seem to go on a systemic basis, even if some pockets remains. We see evidence that the firms took the opportunity of the crisis as an opportunity to transform. And there I will compare a little bit what happens in the EU and the US. It seems that, in fact, Europe is transforming not as fast as the transformation at the micro level is happening in the EU. But it also is explained by the structural feature of the economy. And last, I will point to the huge potential that we see in Europe, the fact that the recovery and the support during the crisis has been associated to the Recovery and Resilience Facility, but basically to a way to raise potential growth and the importance of the policy guidelines, both on this focus on potential growth and focus on the climate transition with very strong policy guidelines. So with that, I will go through a few slides. The first is very obvious. The dynamics in terms of recovering in GDP, both in the US and the EU, and we see the very strong capacity both ways to recover from the crisis. On the EU side, we were surprised about the positive dynamic in the recovery. And particularly what was surprising on the positive side was the capacity of investment to slowly move back to pre-crisis level much faster than what we have seen in the past. And that's definitely due to the very strong policy support that we have seen. I will just analyze on the microeconomic level, and the way in which I will go through it is using a survey. Actually, it's the first time I'm showing these results. It's a survey that we run every year, focusing on 12,000 firms in Europe, 1,000 firms in the US. They are representative of the structure of the economy, and it's a very good instrument to try to understand how firms are transforming, because we work with balance sheet information, survey information, and combining the two, we really understand what are firms doing. So the first part is looking at the impact of the crisis on sale. 50% of European firms have been seeing a decrease in terms of sales through the crisis. And on the other side, also impact on investment. 26% of firms have seen a contraction in terms of investment. This is in the effect in 2020. What we look at is that the impact of the crisis has been very much differentiated across firms and sectors. And this is interesting because what we see is that when we ask to firms in 2021, what happened to their sales, we look at the characteristic of the firms, we see that digital firms have been much more resilient to the crisis. The most productive firms pre-crisis has been much more resilient, which are good news in terms of the dynamic of firms. On the other side, we also look at sector specifically, and we do some simulation on balance sheet of the firms and look at anchoring the sales dynamic to what is actually happening at the sector level for which Eurostat aggregate data on dynamic of the sector, and modeling also the natural response of the cost side, but also the specific impact of the policy support on firms. What we end up seeing is that the impact of the crisis, even after the policy support, in some sector has been reflecting in a percentage of firm recovering losses that is some 3 times higher than a normal period for the sectors. This is in the hotel restaurant sector, but also it's much higher in transport, machinery and transport equipment, and textile and other manufacturing. So what you see is the part of the concern is that in these sectors you may find some pocket of vulnerability remaining, and those sectors may weight more in some of the countries, so some pocket of vulnerability may stay more concentrated in some countries. But still, thanks to the positive policy support, this is a situation that is much more resilient than what we were expecting and forecasting at the beginning of the crisis. Then we see what is the specific impact of the policy support. So through our survey, we ask firms if they received the policy support in various ways. Those are the European firms. We see that 56% received financial support during the crisis. And what is interesting is that if we look at who received the support, distinguishing firms in terms of the impact of the crisis on their own sales, you see that actually support went mostly to the firms that were most affected. They were more likely to receive support. And the second graph is particularly interesting. It's also with all economic regression, econometric regression that we have been doing. But basically, it shows you that firms were able to keep investment plan, also if they had a strong impact in terms of sales, thanks to the policy support. So basically, the policy support was allowing firms to keep their investment plans independently of the sales loss. And that's a positive message that we see. At the same time, and that's more forward-looking, we ask to firms if they believe that the crisis will have a long-term impact. And what you see is that the majority of firms, actually more than 70%, think that there will be a long-term impact. And there is mostly the factor that they consider the biggest change is increased use of digital technologies. So actually what we wanted to understand is if firms think that in the long term they will need to have increased use of digital technologies, did they take the opportunity of the crisis to transform? And that's what we see. We see that European firms, some 30% use the crisis as an opportunity to accelerate a planned transformation. It's something, it's 30% is not a huge number, but still at the same time, firms were trying to move. And actually, EU firms have also tried to become more digital. We see 46% of firms that through the crisis started some digitalization. And this is also included 34% of firms that did not implement any advanced digital technology, but took the crisis to start what we call a digitalization journey, starting remote working, starting online sale. So first steps toward digitalization. So somehow we have some indication that the crisis was not lost in terms of an opportunity for transformation of firms. But still, on the other side, concern, the crisis was the policy support allowed the finance constraint to remain extremely limited, and we see very low level of firms that are finance constrained at the European level, even among the small and medium enterprises. But the second element is the one I was warning before. If we build a vulnerability indicator looking at the potential deterioration of a balance sheet of the firms in different sectors, and we aggregate those at the country level, and we compare it with the overall lost GDP during the crisis, what you see is a number of data points. Each data point is a country at the European level. You see some countries more at vulnerability, while the GDP loss was higher, and there are higher share of firms at risk, vulnerable, at risk of vulnerability. The green points are countries in the south of Europe. So those are countries traditionally also with higher debt level. So this is some sort of concern going forward. I switch to the more aggregate level, if you want a more macro level, and what I will do is starting from this view at the European level compared to what's happening in the US, and trying to give some final point in terms of what to expect next. So I started to looking at the support at the EU and the US level. We have already talked about the difference in size, but what I wanted to put in the picture is also the contingent liabilities guarantees that are an important part of the support package at the EU level. And the interesting part is if it's true that the pocket of vulnerabilities that I mentioned before at the end will not materialize, that may be a very efficient way for Europe without a major fiscal stimulus with contingent liability to support the recovery. But then the approach has been substantially different at the micro level. On the US, a very strong focus on household and relying on the firm's more dynamicity and capacity to adjust. So the effect was really waiting on the strong household support and expecting the supply side to dynamically adjust to that. On the European side, the approach has been different. It has been very much focused on resilience. Credit guarantees reduce the downside risk at a firm's level. The furlough system and labor subsidy kept employees under contract while firm bankruptcy filing duties were relaxed. And everything was also more adapted to the EU more rigid labor market, but also to the stronger security system at the European level. So what do we see in terms of difference in the labor market? I think we discussed it even before, but I think it's interesting to look at what to expect. In the US, it's the red dots. So what you see is through the crisis, a very strong increase in unemployment, a very quick correction, and now indication of mismatch in the sectors that have all the implications that we are seeing also in terms of inflation. On the EU side, the dynamics has been much more constrained, both in terms of unemployment rate, the adjustment has been in terms of hour worked. That's a much lower dynamic in the labor market, but the pros and the cons are associated to that. On the one side, whatever we discuss on inflation in the US is not reflected at the European level, because the adjustment in the labor market in rising demand can still be done through the increase in our work. But on a different point of view, if we think that we are in a moment of structural transformation of the labor market, and that you need over time a stronger adjustment and shift of jobs from some sector and some qualification to others, this process may somehow delay the readjustment, and you take less the crisis as an opportunity to transform. So it has to be associated to very strong active labor market policies and also retraining of people in the job. And that's one of the aspects. The second aspect that I wanted to mention on the European side, it's this recovery and resilience facility, which had a very strong focus on the public investment and on increasing the potential output, if you want, at the European level. And what we see is that actually this very strong focus on public investment is materializing in expectation for gross fixed capital formation at the public sector level, counting the national component of single countries, plus the recovery and resilience facility component. And actually the recovery and resilience facility will kick in the moment in which you will see some deceleration of the gross fixed capital formation at the national level. And this is an important part, particularly if the recovery and resilience facility will be well used. And that's the very big challenge at the European level that we see now. Here I'm showing what are our expectations in terms of growth. This would be wider GDP growth at the European level. So we are talking about 3-4% larger nominal GDP with the recovery and resilience facility versus a situation in which there would be no recovery and resilience facility. But what you see is a very strong short-term impact, but still impact remaining in the long term, 2030, 2040, thanks to the focus of this recovery and resilience facility also in human capital investments and also the physical capital part and endogenous growth and the R&D component. But the challenge at the European level is to maximize the impact of this program and make sure that the maximum in terms of planning, deployment, and spillover emerging from the various projects is implemented. The last question was already mentioned. Still, we have one area to work out at the European level. Patricia was mentioning the very strong potential cliff effect in terms of fiscal policies, fiscal policy at the US level. We have a similar challenge at the European level, and that's what is being, I think, also in the previous panel was widely discussed. And the issue is the 2023 is the critical year in the moment in which the fiscal rules that apply at the European level will become binding again. If we mathematically apply the fiscal rule, some countries, the most indebted one, will have a very strong consolidation process to go through. It's something that is non-desirable at the macroeconomic level, at the European level, and that's why the work in terms of how to adjust the process and avoid the strong consolidation is quite important in this moment in Europe. Just to conclude, the microeconomic impact of this crisis, scaring losses scaring is less than previously expected, with some risk of pockets of scaring remaining, some evidence of firm transformation. The difference between the US package that at the micro level have been working, also taking into consideration the different structural condition and the different flexibility of the underlying structural dimension of the economy, and the importance of the investment package and the link to potential growth in the EU, which is something quite important. Also associated at the very strong policy narrative associated to the climate transition. Thank you very much.
Thank you very much, Deborah. The topic of supply bottlenecks has been addressed several times during the last 3 hours or so. So what is the likely duration and what is their impact? What dilemmata might this cause for policymakers in the short and medium run? Jan, I'm very interested in your insights.
All right. Thank you. I'll start with that and I'll address some of the other issues that have been mentioned as well. So yes, obviously the impact on trade flows have been dramatic, asymmetric. Some countries have been affected much more than others. Some of it relates to anti-COVID policies, which, for instance, were stricter in Asia, still are stricter in Asia, which is the source of many raw materials and intermediate inputs. And the shipping industry has been very uneven in terms of what it has been delivering and in terms of the cost. So we've seen prices of transportation at some point reaching multiples of what it was before. And the question is why and how temporary or transitory this is going to be. So the shipping sector has been, in particular, very, very important. Ports, the capacity at ports, it's not just the ships have been there. There is strategic interaction where there are reports that ships often wait, not only because they have to wait in order to get into ports, but because prices are rising. And it pays to actually delay the delivery, hoping to get a higher price than if you deliver the whatever cargo you have right away. So there are all sorts of natural as well as strategic aspects to the problems. Then there are, if you compare the US and Europe, there are areas where there are natural differences given the different resource endowment, energy, in particular, be it oil and gas. The US is much more self-sufficient than Europe, and Europe, in addition, has issues related to not unfinished infrastructure in terms of distribution in some respects. So there are local issues that are arising as to whether the current winter will be particularly tough. Prices have already been rising, and it was a result of the factors that I mentioned, in addition to the fact that last winter was a tough winter. So all these brought together together with the COVID inability to react in terms of civil service, public administration operating, have been there. Now, there have also been effects that are kind of longer in nature. For instance, farmers around the world have planted less of products. Cotton is a good example. Everything based on cotton prices are going up because there is less acreage that has been sown. And there you have to basically wait the cycle of sowing and harvesting in order to compensate for that. So some of these effects are not just sort of temporary bottlenecks that could be reduced through logistics, but to have a cycle which is more of an agricultural type cycle, for instance. I'd like to say also a few words in terms of the different dynamics that you see not only between the Europe as a whole and the US, but also the Eurozone and the countries that are not in the Eurozone. Poland, Czech Republic, Hungary, Romania have pursued different policies having different expectations. So there are different dynamics in anti-COVID policies that already have been mentioned, but the central banks have also pursued different policies. And in particular, while we have seen that the European Central Bank and the Fed are seeing the current inflationary pressures as temporarily and have not really been reacting yet, certainly not in terms of interest rate adjustments, the countries like Czech Republic, Poland, Hungary, Bulgaria have actually started, some of them aggressively, raising interest rates. And that's in the face of major debate whether they really can be effective, given that many of the reasons for the inflation that they are observing are external, that the inflation is imported into these very open economies. And raising interest rates may, in fact, stifle economic growth, which, like in the Western countries within the European Central Bank area and Euro area and the US, is still very fragile, and in many of these countries has not reached yet the 2019 level. So I'd like to point out that there are sort of differences in approach, even within the European Union, between the countries that are in the Eurozone and those that are outside of the Eurozone. And its question is why we see actually such a rushed approach in the non-Eurozone countries on average compared to the Eurozone countries. So I think this is sort of interesting. Related to that is, I think that would be interesting to understand a little bit more the benefits, but potential costs too, of the interaction between the central bank and the Ministry of Finance or Treasury. In the US, we have a very close intellectual as well as personal interaction. I mean, currently the head of the Treasury is a former head of the central bank of the Fed. In Europe, you obviously have one, in the Eurozone, you have one central bank and many ministries of finance. And the question is whether the interaction is different when you have the centralization for one of the pillars of policy and relative decentralization at the country level for the other. So I think that that's an interesting thing. In terms of the inflation and how countries react to it, I think it's also important to realize that what we are now observing at this phase is that there are complete bottlenecks in certain areas, like automobile companies are closing down temporarily because they just don't have chips, and some other areas. So in terms of measuring inflation, when you have complete quantity constraint, the price approaches infinity, right? Basically it's infinite because you cannot get any more. So how do we cope with the concept of inflation when certain commodities or certain products are just not there? I also think that what we are observing, it will be interesting to see how it differs across the different continents and countries within, is the deglobalization of supply chains when it comes to products, where basically firms want to have key inputs closer to home within the EU, let's say, or within NAFTA, whatever would be safe, and the increased globalization in terms of the use of digital technology. All these countries have been, as Debora and others have been mentioning, are investing heavily, both at the government level, in terms of government policies, and in terms of firms in digitalization, right? So that means that things that you can carry digitally across would not be affected by bottlenecks of the kind that we've seen in shipping and other areas. And so one would expect that there will be increased globalization in terms of digitally run technologies and deglobalization in terms of the shipping and transportation of products. So I think that's that's important. Let me go back to one other thing that I would like to mention with respect to the differences within Europe between the Eurozone countries and the ones that are already increasing interest rates, some of them dramatically, is that the cost of financing government debt is rising considerably. And these countries are probably going to face issues that are not being faced in the US and in the Eurozone. Thank you.
Thank you very much, Jan. I think we have 2 or 3 minutes left. So could I invite you for an impossible task? Could you just in 30 seconds state what is the main challenge and the most important thing that policymakers need to do in the next 12 months? Just one idea. Do you want to start, Jan?
Last time. I think that they really, speaking of resilience, should be ready for what to do in the next wave, should the next wave come. And I think that despite all the experience that we had and gathered, that in many instances, the policymakers are not quite ready to act decisively should it happen.
Okay. Elga.
So in the case of Europe, I think the main thing is to, as much as possible within the existing treaty, the fiscal rules, because I do think that this is an important factor, not just in terms of avoiding the cliff in 2023 when the Stability and Growth Pact goes back, but also longer term, because for the ECB to be able to do its job, it needs fiscal policy to pull its weight as well.
Thank you. Debora.
I think I share Elga views. On the one side, the allowing through the a moderate, if you want, a fiscal consolidation going forward with some kind of a flexibility of reform of the Growing Stability Pact. And also the second point, I think, really taking the opportunity of the Recovery and Resilience Facility. So the money are available as long as single countries are presenting the project and executing projects. So failing to do so now in this moment would mean a very strong lost opportunity. So that's implementation capacity is essential.
Thank you, Debora. Patricia, you have the last word.
That's a little scary for everyone, but so for the U.S., so I'll stick to the U.S. here. I think the United States needs to think very, very seriously about the policies to facilitate the structural changes that I think, and I think a couple of other people here believe are going to persist for some time. I thought Deborah's characterization of this is that let the private sector figure it out is about right. But given the fiscal consolidation in the United States, if there's going to be any kind of fiscal expansion passed, it really needs to be completely refocused from COVID, which was income and business support. And it needs to go to how do we get people back in the labor market aligned with the right industries? How do we provide this sort of structural changes and incentives to assist in that process rather than getting in its way or just letting 1,000 flowers bloom, because the risk of that latter strategy is it will take a lot longer for this to be sorted out. And what will happen is probably higher inflation and slower growth if they don't.
Thank you very much, Patricia. Now, this session has touched upon several important topics and challenges which are at the core of policymakers' current work and thinking going forward. I thank Elga, Patricia, Debora, and Jan for your rich and very stimulating contributions.